Japan ends negative interest rate in 2026. This is not a minor tweak. It is the end of an era that shaped global finance for over a decade. The Bank of Japan has kept rates below zero since 2016. Now, in 2026, it exits negative territory for good. What follows will ripple through every major asset class, every major economy, and your own portfolio. Let's start with why this happened. Japan's negative rate policy was born from decades of stagnation and deflation. After its asset bubble collapsed in the early 1990s, Japan struggled with weak growth, falling prices, and cautious consumers. The Bank of Japan cut rates repeatedly. By 2016, it introduced negative rates to force banks to lend, push businesses to invest, and lift inflation to 2%. For years, the policy did not work as planned. Inflation stayed low, wages barely grew, but the policy became entrenched. It distorted financial markets, crushed bank margins, and pushed Japanese capital overseas in search of positive yield. Then, after 2022, everything shifted. Global inflation surged. Japan's inflation finally broke above its 2% target and stayed there. Wage growth picked up, supported by tight labor markets and corporate reforms. The yen weakened significantly, raising import costs and adding to price pressures. The Bank of Japan faced a simple reality: negative rates were no longer necessary. They had become risky. In 2024, the Bank of Japan took its first step, lifting rates from negative to 0.01% in 2025. It raised again. By 2026, inflation is sustained, wage growth is solid, and the economy avoids recession. The Bank of Japan officially exits negative rates and begins a gradual normalization cycle. This matters because Japan is not a small player. It is the world's largest creditor nation, with overseas assets totaling more than $10 trillion. For years, Japanese investors, pension funds, insurance companies, banks, and retail investors chased yield abroad because domestic rates were zero or negative. They bought U.S. treasuries, European bonds, emerging market debt, global equities, and real estate across the world. Cheap yen funding also fueled the global carry trade. Investors borrowed yen at near zero cost, converted it into higher yield currencies, and invested in assets from U.S. tech stocks to Australian bonds. This carry trade became one of the largest sources of global liquidity. It suppressed volatility, kept borrowing costs low, and inflated asset prices across markets. When Japan ends negative rates, two massive forces reverse: capital repatriation and carry trade unwinding. First, capital repatriation. As Japanese domestic rates rise, domestic assets become more attractive. Pension funds and insurers shift money back from foreign markets to Japanese bonds and equities. This outflow from global markets is not trivial. Japanese investors hold over $1 trillion in U.S. treasuries alone. Even a moderate reduction in foreign exposure puts downward pressure on global bond prices and pushes yields higher. Second, carry trade unwinding. Higher yen rates increase borrowing costs. A stronger yen reduces profits on foreign investments. Investors close carry trade positions, selling foreign assets and buying yen to repay loans. This creates a self-reinforcing cycle. Asset prices fall, volatility rises, more positions are cut, and liquidity tightens. Now let's break down what this means for the global economy and your investments. Start with bonds. Global bond yields will move higher. U.S. Treasury yields, German bond yields, and UK gilt yields all face upward pressure. Higher yields mean higher borrowing costs for governments, corporations, and consumers. Mortgage rates rise. Corporate loan costs increase. Emerging market debt becomes more expensive to service. The era of extremely low global interest rates is over. For equities, the impact is split. Higher bond yields reduce the present value of future earnings. This hits growth stocks hardest, especially unprofitable tech companies and speculative names. Value stocks and financials tend to perform better. Banks benefit from wider net interest margins. Companies with stable cash flows and reasonable valuations outperform expensive, growth-dependent stocks. Japanese equities have a mixed outlook. Financial stocks rally on higher rates. Export-oriented manufacturers face pressure from a stronger yen, which makes their products more expensive overseas. Domestic-focused companies benefit from improved consumer spending as wages rise. Currency markets see major shifts. The yen strengthens over time. The US dollar weakens against the yen as the large interest rate gap between the two nations narrows. Euro and other currencies adjust accordingly. Emerging market currencies face volatility as capital flows out. Commodities are affected through multiple channels. A stronger yen tends to reduce commodity prices, as most commodities are priced in dollars. Higher global interest rates slow economic activity and reduce demand for industrial commodities. However, supply constraints and geopolitical risks can offset some of this pressure. For real estate, higher interest rates cool property markets globally. Mortgage rates rise, reducing affordability. Commercial real estate faces additional pressure from tighter credit and slower economic growth. In Japan, higher rates improve bank profitability but increase borrowing costs for property developers and homeowners. Now, what does this mean for you as an investor? First, expect higher volatility. The end of Japan's negative rate era is a major macroeconomic shift. Markets will reprice assets across the board. Sharp swings in bonds, equities, and currencies become more common. Second, adjust your portfolio for higher rates. Reduce exposure to long-duration bonds and expensive growth stocks. Increase allocation to shorter-duration fixed income, value stocks, and quality financials. Diversify across regions and sectors to reduce risk. Third, watch the yen. A strengthening yen affects global trade, corporate earnings, and currency-hedged returns. If you hold international assets without currency hedges, yen appreciation impacts your portfolio. Fourth, monitor central bank reactions. The Federal Reserve, European Central Bank, and other major central banks will adjust their policies in response to Japan's shift. If global yields rise too quickly, growth slows, and inflation cools, the Fed may slow its tightening or even cut rates. Fifth, focus on quality. In a more volatile, higher rate environment, high-quality companies with strong balance sheets, consistent cash flows, and reasonable valuations outperform speculative and highly leveraged names. Some investors ask, is this the start of a global recession? Not necessarily. Japan's policy normalization is gradual. The Bank of Japan will avoid aggressive tightening. The global economy has already adjusted to higher rates since 2022. Growth may slow, but a severe recession is not the base case. Others ask, will Japanese stocks benefit long-term? Yes, but selectively. Higher rates improve bank profits. Wage growth supports domestic consumption. Corporate governance reforms continue to improve shareholder returns. However, yen strength caps export gains. Another key point, the end of negative rates is a sign of Japan's economic recovery. After decades of stagnation, Japan has stable inflation, rising wages, and improving corporate profitability. This is positive for Japan's long-term outlook, even if it creates short-term global volatility. For global markets, the adjustment period will last several years. The carry trade will not disappear overnight. Capital repatriation will be gradual, but the direction is clear. Global liquidity will be less abundant. Borrowing costs will be higher, and asset prices will reflect a more normalized interest rate environment. Your takeaway as an investor, do not ignore this shift. It is one of the most important macro events of the decade. Review your portfolio, reduce exposure to assets that benefited from ultra-low rates, and position for a world where rates are higher. Volatility is normal, and quality matters more than ever. If you want to stay ahead of these macroeconomic shifts and understand how major policy changes impact your investments, make sure to subscribe. Hit the subscribe button so you do not miss the next analysis on global markets, central bank policy, and portfolio strategy.